Markets are really experiencing some unprecedented moves right now. The drop in oil, 20 to 30% in one day. The drawdown in the broad indices. It's really unprecedented in the scale and the speed of which it's dropped. And the problem right now is no one can give definitive answers of when the coronavirus is going to be cured or when the imminent recession is going to come or not come. And it's really that fear of the unknown that is causing some market participants to panic. And there's no answer that I can give to fully allay fears of an imminent V-shaped bounce back because no one knows for certain that that's what's going to happen. Advice for clients really has to be in line with what you feel comfortable, what risk you feel comfortable taking on. However, don't try and time the market. All the evidence we've seen over history is that investors are really poor at getting out as the market's dropping and then getting back in when the market's rebounding. There's really only one mistake an investor can make throughout the history of investing, and that's selling at the bottom. If you miss just the 20 best days over the past 20 years, you would have wiped out 100% of your returns over that time period for the TSX. So instead, be comfortable with your asset allocation and be able to perhaps either dollar cost average in or dollar cost average out to help alleviate some of those fears. Today's market price is probably not the low. Tomorrow's low probably won't be the cycle low either, but we don't know when that rebound is going to happen. And there are a number of differences between the situation today and the situation in 2009, for example, during the financial crisis. Today, there's a factor, the coronavirus, that is causing people to just tighten up and cause people to not go out and spend, not travel, and that's causing a short-term demand impact. However, unlike in 2008 and 2009, there's not massive fraud in the system. There's not excesses in valuations or any bubbles forming. The US consumer, for example, is much healthier today than they were in 2008. Saving rates are high. Debt service ratios are low. Unemployment is extremely low. So there's reasons to believe that there's going to be some sort of built-up demand that will come back to the market when those fears alleviate. We also know that interest rates are extremely low at all-time record lows, and that the federal government is there for monetary and fiscal stimulus, as well as many other countries around the world that are going to be throwing everything they can at this economy to get it moving again. We don't know when that's going to happen, but we know we want to be positioned for it. So we're not throwing out the babies with the bathwater. We're using the opportunity to high-grade portfolios, to move to the highest quality companies, to be best positioned for that rebound when it happens. There's two sets of assets that we need to think about. The asset where the allocation is a little bit more flexible, where you could raise cash and you can move more defensive, and there's another set of assets that are going to stay fully invested, and that's the money that we're managing for clients. For the money that's staying fully invested in mutual funds, for example, we're not sitting on our hands and doing nothing. There's 5 things that we're doing within those funds. The first is looking at balance sheets. Any company that is at risk in the short term due to their leverage is something that needs to be taken out of the portfolios. We have to be invested in the companies that can use this market disruption to their advantage as opposed to it causing risks from an ongoing basis. The second thing is we're looking for switch trades. Which companies with similar exposures are down more than others? Because right now everything is moving lower but at different paces. So we're looking for the switch trades in the portfolio. The third thing is we're looking for companies that have just overreacted. Which companies are discounting a worst case scenario recession, even though the cash flows are still recurring and ongoing. The fourth is we're looking for the opportunities in the companies that have recurring earnings, that have domestic-focused earnings, because we think that Canada is going to be less impacted than some other emerging markets around the world. We're looking for the companies that we know where their next dollar is going to come from. Think about all the companies whose bills you receive every month that you're going to continue to pay. Those are the telcos and the utility companies. We're starting to sharpen our pencil on those cyclical companies, the companies that are down the most now, but are likely to snap back at the time when the stimulus and the recovery begins. We're too early at this stage, but sharpening the pencil and getting ready for that rebound is important.